Good morning, everyone. It's Vince Vora here. We'll be starting in just a moment. Before we do, I just want to make sure that everyone can see my screen and hear me clearly. If you can, please let me know by typing in the chat. Excellent. Thank you very much. I see Maria, Farzad, John, Ron, Rick. Thanks, everyone, for joining us this morning and taking time on a Saturday to be with us. This morning, I'm going to be talking about the power of indicators and oscillators. There's a number of them we're going to go through today. Hopefully, we get through all of them. But for today's session, what I would really like to do is really share ideas on how everyone prefers to use these indicators. I've obviously been around for a very long time in this industry, and whether I'm trading shoulder to shoulder with other pros or spending time just with other retail traders, there's always different ways of using indicators. And I'm going to share with you the traditional way to use each of these indicators. I'm going to show you how I prefer to use these indicators. And then in some instances, I'll share some ideas that some of my colleagues have used to trade with these indicators. But as we go through them, I would really like to hear from all of you. If any of you use the indicators I'm going to cover and use them slightly differently, by all means, if you can type it into the chat, and I will share it with the group. One thing this morning, I am flying solo here. Raul could not join us this morning, unfortunately, but so bear with me as I go switch between my charts and the chat, but I promise to get to as many of your questions as possible. So when we first had the idea of doing this, I asked all of you to let me know which indicators you wanted me to cover and so on, and I ended up getting a long list. So I think we're going to have to do this over multiple classes. I've selected a few that I think are important and that I think will be beneficial to you. We'll start with those. Hopefully we'll get through this set today, and then we'll cover the rest in a future session, okay? So unless there's any questions right off the bat, we'll get started. This is what we call technically speaking. It's the power of indicators and oscillators. Please do remember that trading can be risky, so please don't trade with real money until you're completely comfortable. Now, in today's presentation, I've only got a handful of slides here. Most of the chart is going to, most of the course is going to be spent on the charts, but I'm going to quickly cover what indicators and oscillators are, the difference between leading and lagging, which are terms I'm sure you've heard many times. And then, as I mentioned, I'll talk a bit about how they're used traditionally, how they were meant to be used, and how I prefer to use these. And along the way, we will try to answer questions. So for the questions, I'd prefer to do it after each individual indicator, just to make sure we cover everything for that particular indicator before we move on to the next. So indicators and oscillators. Now, indicators are they're based on price and on volume, and they measure things like money flow, trends, momentum, volatility, that sort of thing. Examples of indicators are like a moving average, for example. Very simple, and we'll go through a lot more of this as we go through the presentation. On the flip side, an oscillator is a tool that's branded between two extremes. Think of, for example, the CCI that could have a plus 100 and a minus 100 reading. And so it oscillates between those levels. And when it approaches the upper end of that level, it's considered overbought. And when it approaches the lower end, it's considered oversold. And don't worry about it if it's not very clear right now. Once we get to the chart, I'll make sure it's very clear for you. Now, when it comes to leading versus lagging indicators, this is an area that some people can get confused with. Really, a leading indicator gives you some sort of signal of what's about to come, okay? So you get an opportunity to consider entering a trade before that burst happens and it actually makes its move, okay? But they can give you a lot of false signals, okay? So lagging indicators and chart formations are often used in conjunction with those leading indicators to confirm that entry or the exit, okay? And that's the real key here, is the combination of them together, not using individuals. And there are instances where you do want to use an individual indicator. We'll talk about that as well. But usually when you combine them, you get a much better or consistent result, okay? A leading indicator is strongest during sideways patterns or channels. Again, you want that opportunity to spot that breakout before it actually happens. And that's why you would use something like a leading indicator when you're in that sideways pattern. Now, an example of a leading indicator would be an RSI, stochastic, CCI, Williams percent R. Those oscillator type indicators are known as leading indicators. And lagging indicators are moving averages, Bollinger Bands, that sort of thing. They can also be, changes in GDP, the unemployment rate, corporate profits. So something we would look at to make an informed decision on where the economy might be going and how it might affect the markets. But it's not something that can be used to say, hey, Yahoo's about to make a run starting today. And so, if the unemployment rate drops half a point, Yahoo's going to break down or jump, you don't use them that way. That's why they're considered lagging indicators. It takes a period of time for that stat to take effect and really impact the economy and the markets and go from there. But certainly looking at both or using both together is really the way to go. Now, this is the list that I've put together for this class. And this, again, was all based on your feedback and what you wanted to see. This is just a short list of what I was sent from all of you. But there's a number on here that I think can be very, very helpful, from volume indicators, the bands, indicators that are usually used for exits, many that are used for divergence or entries, and some that are not as common, like the vortex. I'm not sure many of you even know what that is. But once again, if you do, or any of these, and you have a certain way of using these indicators that really works for you, by all means, please share with the group. I'll go through each one of them for you. So, any questions on what we're about to do before I get started with the on-balance volume indicator? Okay, so I guess not. I guess we'll jump right in. Many of you have started to type in other indicators that you would like to see, or may not see the one you were hoping to see on here. As I mentioned, I got flooded with a number of them. We will cover them in future classes, I promise. So let's start looking at the on-balance volume indicator. Now, what this measures is buying and selling pressure. And the way it works is whenever there's an up day in the stock, we add that day's volume to the running total, to the cumulative total. And when it has a down day, we subtract it from that. So as a stock starts to trend in one direction, you see a volume either increasing or decreasing along with it to confirm that. We can use this to look for divergences between the on-balance volume indicator and price, okay, to predict that movement, or even better, to confirm that trend, okay? And what we should do is expect prices to move higher if that on-balance volume indicator is rising, while prices are either flat or moving down. This is the divergence, and I'll show you an example on the chart in a second. Or you should expect prices to move lower if the indicator is falling while prices are either flat or moving higher. So the way you want to think about divergence is whichever indicator you are using to judge whether there is divergence or not, the indicator always wins out. In other words, whether you're using the on-balance volume indicator, the MACD, or any others for divergence, the direction in which the indicator is pointing is usually the way things work out. Okay, let me bring up my charts and show you this one here. Let me add it on here for you. So let's find on-balance volume. There we go. Now, for all of these, if I don't specifically go in and change the setting, it means I am using the default settings. And the default settings are very consistent among all charting platforms. Okay, so whether you're using TOS or TradeStation or any other, it really doesn't matter. In most cases, we'll be using the default settings. So let's put on the on-balance volume indicator, as you can see down here. And so you'll notice that when price is rising, generally the OBV rises as well. And when price is dropping, the on-balance volume is dropping. Now, one thing to look at is you see how in most cases there's a lot of zigzags in here on the on-balance volume, okay? Because, you know, usually if you have an up day, you're adding volume to it. You have a down day, you're subtracting volume from it, etc. So it's normal to have that. The way you can spot the really strong trends are when you don't see a zigzag, when you see a solid line like you do here. These are the times where you're getting those consecutive down days in a row or up days, and that's one way to quickly spot a very, very strong move in that direction. Okay. Now, divergences is one of the major ways to use this indicator, and let me show you an example. But before I get to that, I just wanted to show you that one of the easy things you can do with the on-balance volume indicator is use it in a way to confirm a trend line break. Okay, this is one of the ways I've seen it used. It's not a way I use it very often, but I will show you that if, for example, you use a trend line and you're waiting for a break here, okay, and during the same period, now you want to put your crosshairs and use the same points, okay, same starting point, okay. If you draw the trend line across the actual indicator itself, like that, if you get the break, like you'll notice here that the break on the price portion of the chart here happened, you know, after it had already broken the line on the indicator. So in other words, the indicator had given you a bit of a heads up, okay, 1 or 2 bars before, that there might be a trend line break here. And then in fact, we got that breakout. Okay, so I know a number of people that use it that way. That's one way to use it. Louis says, some people apply moving average to OBV. Have you heard of that? I have. I haven't seen many pros use it that way, I'll be honest with you. But yes, Louis is right. You can put a moving average right on it as well and look for those crosses as well, those changes. The way it's used most often, believe it or not, is with divergence. And this is what I mean by divergence. So if we look at here AGN, and you know what you want to do is draw a trend line on the indicator as well as the actual candlesticks or the price bars here during a certain area. So for example, if, and this might not be the best example, but what you want to look at is, for example, if you draw, you know, here from point to point, okay, and you take the same 2 points on the indicator, okay, you'll see that the indicator is actually pointing lower while this is flat. And normally you're looking for divergences that are a little more dramatic than this, but this is in itself a heads up. Okay, just like, if you go even from this point on here across, still very flat, while you take that same point, and again, we were heading lower that whole time. So the indicator always wins out. Okay, you rarely see it where price will actually win out as far as the direction of that line that you're drawing. Okay, it's always the indicator. So when you see a difference like that, you got to pay attention to it. Now, the key with divergences is that you never know when it's actually going to start moving in that direction. Okay, even though it's sloping and it's telling you that, hey, it looks like there's a down move coming, you can't just use that trend line on the indicator like that to tell you when to get in. That's the key. You really have to look for some kind of sign. Now, when you see something like this in here, okay, what is this? Right? You should all know what this is. It's a double top. Okay? So how do you get into a double top? On the break of the midpoint, the midpoint low, right in here. So right in here, this would have been the candle, or one way for you to enter here. Okay? You could also use a strategy, like one of our winning momentum strategies, our favorite trade, or veracity, that sort of thing, to look for a signal or a setup in and around this area where you're getting that divergence. Okay? But you always want to wait for some type of pattern on the chart to tell you that, hey, it looks like there's a trade about to move in that direction. Back in here, there was an engulfing pattern, a bearish engulfing pattern. Okay, so whether you want to take that trade right away, or if you come to the chart and you notice that after the fact, hey, there was some nice divergence there, it really hasn't fallen apart yet, and then you see a signal like this, it's something you can certainly jump on. Okay. So Vasu is saying, so when there is a divergence between the indicator and price graph, the indicator wins. That is correct. So you're using the direction that the indicator is showing you as the direction for the next move. Then you're using a chart pattern or a reversal signal or something like that to let you know when to get in here. Okay? That's the real key. So, and you want to take, you want to look at points. So, when you see, if you take points, actually, let me get a different indicator here. So, if you're judging from this point to this point, you gotta draw your line from the same points on the indicator. So this point, and then drag it over to this point. Now you'll see that they were both sloping higher. So there's no indication at that point that it's going lower, okay? But something like this would. Now, if price was flat and the trend on the indicator was higher, then you would be looking for a setup to the long side to take place, okay? That's how it's used. Now, as we go through examples, we'll look for some stronger divergence examples here, because some of the other indicators are also used for that as well. Daniel is saying, about divergence, have you found some indicator to be more reliable than others, or how do you choose which one to use to look for divergence, OBV, MACD, etc.? Daniel, I personally find MACD more reliable, and maybe it's because it's just easier to read. When we get there, because MACD is one of the ones I will cover today, using the histogram, the MACD histogram, it's very, very visually easy to spot on the chart, and that's probably why I use it more often than not. Karen is saying, would you use the standard settings for a day trade on a 5-minute chart? For unbalanced volume, I would. For something like the MACD, I would not. I changed those settings dramatically, and I'm going to give you those settings when we get to the MACD. Okay. You can also use this indicator to look for breakouts near areas of support and resistance. Okay, so let's say that we identify this area here as support or resistance, and we're waiting for some kind of break. Okay, again, we could use the same kind of thing on the indicator itself here to confirm that. And sometimes, like it did back in here, it will actually break out before the actual breakout on the price chart. Okay, so if it's something you're waiting for, it could be a channel, it could just be a very strong level of support and resistance like this, and you're looking for a reason to short. You could use this, draw the trend line on the actual indicator, and it will usually give you a heads up 1 or 2 bars before that. Okay, that's another way of using it. So that's the on balance volume indicator. Any questions on that before we move on? As far as volume indicators go, this is one of the more popular ones. The other way that individuals use volume, regular volume, actually, let me just throw it on for a second here. Okay, when you talk about using regular volume here, what you're really looking for is spikes. You're just looking for the things that catch your attention. Okay, and whenever there's spikes like that, obviously there was heavy buying or selling. And it's generally by the institutions, because by the retail traders, the spikes aren't usually big enough. In other words, retail traders don't usually trade enough to cause such a spike. And so these spikes are usually by what we call the smart money or the institutions. All right. And so really you should be looking at those just to, as a heads up and try to understand, hey, what's going on now? In this particular spike, there must have been news, it gapped lower. But if you get a big spike on a regular pullback, such as this, let's say we had a huge spike here, okay, volume here, and then you saw a bounce, that would typically mean smart money came in and did some buying. And then what you're looking for is another drop in around the same level and another spike. And if you saw that, that would tell you that every time it gets to that price level, the institutions are loading up. And so when you see that, then you wait for a clear turnaround signal, okay? A period where the trend changes from lower prices to higher prices. And the best way to do that is to look for a stock putting in higher lows and higher highs. Okay, and so that's how you would use regular volume. But on balance volume, again, is that cumulative total of positive or negative volume for the day, and it's used mostly to confirm trends and also for divergence. Okay. Let's see, Dennis. I'm using he's asking him if there's a specific setting for the on-balance volume. I'm using the default, and in Thinkorswim, they don't actually show it here. So other platforms might. We don't even have the opportunity to change the setting here. But there wouldn't be any need for that. Okay, only use default settings. All right, so any last minute questions before we move on? And I apologize if I miss any of your questions. I'll try to come back to them. If not, I can certainly answer them in future sessions. So let me clean this up for you, and let me bring back my presentation. I want to talk next about Bollinger Bands. Many of you asked me to cover Bollinger Bands today. And what they are volatility bands placed around a moving average. Now, the default setting on Bollinger Bands has always been the 20-period simple moving average, and then using the standard deviation lines around it. And I'll show you this when we get to the chart. But that's what it's based on, standard deviation. And the bands will automatically expand or contract around that moving average as volatility either increases or decreases. A couple of the ways that you can use Bollinger Bands is to identify double tops and double bottoms. We call them M tops and W bottoms, okay? Or to determine the strength of a move, okay? And I also like to use it to identify breakouts, and I'll show you that as well. But most people use Bollinger Bands, or what they look for on Bollinger Bands is when the two bands start squeezing together. That usually indicates a potential breakout, and that's the most common use. Let's have a look at them on the chart here. Let's put them on. Now, the Bollinger Bands, we can change the settings here. Now, the default is the 20-period simple moving average. That's the length. And then you have, in this case, two standard deviations, one to the upside, one to the downside. We can change that to 1, to 3, to whatever we want. The default is set to 2, and that's what I use most often. Now, let me explain the difference here. So the middle line here is the 20-period moving average, and these are both two standard deviations away. What you need to know about standard deviations is the percentage of time that security's price remains within that standard deviation. What you can count on is if we put a 1 standard deviation on here, price will remain within those bands, within the outer, the lower and the upper band here, about 68% of the time if we had 1 standard deviation on here. If we put a 2 standard deviation, price will remain within these bands about 94% of the time. And if we put a 3 standard deviation, it'll remain within these lines approximately 98.5% of the time. Okay? So those is the real key there. That's the real key when it comes to this indicator, and that's one of the real advantages. At least that's the way I like to use this. So one of the ways that the most common is when the lines squeeze together, like you see here. Okay, price starts going sideways, the bands squeeze together, sometimes very, very tightly. Again, it happened here. And then when most traders see a squeeze like that, they start paying attention or looking for some kind of signal to go long. Okay, you can always, throughout this process, use it to confirm a trend. So in here, obviously that 20 period is sloping higher, and it's confirming the current trend at the time. But and you can look for those M tops and W bottoms. Let me show you a chart of Apple. Now this isn't the cleanest, but you see here this W pattern right in here. Again, normally it'll be much cleaner with the actual Bollinger Band lines. You'll see that this second drop didn't quite get back to the same low. If it did, it would be much clearer. But it's usually easier to spot a double bottom with the Bollinger Bands than it is without. And that's something that you look for. What you will also notice when you see a pattern like this, okay, when you see this kind of potential double bottom, when does the real acceleration happen, or when is that double bottom confirmed? It's confirmed when you get a break of the midpoint high. Well, if you notice, when it did break that, price went outside that 2 standard deviation line. Okay? You'll also notice that it didn't stay outside of that for very long. Remember, outside of 2 standard deviations, it's only going to be there about 6% of the time. So think about this. That's the other way to use it. When price goes outside the lines, you're expecting it to remain there a very short period of time before it pulls back in. So what should you be looking for when you're outside of the bands? You should be looking for a reason to bring it back in. In other words, if it breaks to the upside, you're going to be looking for a reason for a pullback. Some kind of, whether it's a bearish engulfing setup or whatever it is that you want to use. Okay? Now, understand that when it does break, that's a strong momentum move. And so it will typically go several bars outside. And as long as it remains outside the bands like it did down here, there's nothing to do but remain short in this example. Okay? But as soon as you get some kind of reversal signal, okay, then you should expect a move that usually takes you to at least the midpoint line and sometimes beyond. So these are also used like support and resistance, the midline here. If it gets there and it breaks through, well, price should continue on to the next band. Okay? If it hits it and reverses, well, it should come back to the lower band. Okay? So again, most people use it for the squeeze. The reason why I'm not crazy about the squeeze is you often get a whipsaw effect like you do in here. So you had the squeeze, it looked like it broke to the downside, it immediately jumped back up. Now, look at this. It went outside, sorry, wrong drawing tool. It went outside that line and gave us a very quick and strong bullish engulfing pattern. Okay? And it went from this line to beyond the top line. And those are the kind of moves that you want to see. And one of my favorite ways of using this indicator is to actually change the settings and increase it to 3 standard deviations. Okay? 3 standard deviations means price will remain within those lines over 98% of the time. So when you see it pop out, or it doesn't even have to pop out, but when it gets to that 3 standard deviation line, like here or here, you just look for a reversal signal. Okay? Just like in here. And it could be anything. Here's that 3-bar pattern we look for. And where does it go? If it goes to the midline, if it breaks through, it usually goes to the top line. Okay? Just like here. Okay? And that's one of my favorite ways of using this indicator. The other thing is that when you see it break outside the lines, whether you're using a 2 or a 3 standard deviation, once it does, instead of looking for a reversal signal to get you back in, just look at that spot, that area between the bottom line and the midline, okay, in this case, as a zone. And as long as it remains in that zone, it should continue to drop. So in other words, basically what you're doing is using that 20-period moving average as your exit signal. So if it comes out of the line here, you want to basically remain short until you get a move back above that midpoint line. Because as long as it's in that channel, it should continue going lower. There will be zigzags along the way, but as long as it remains in that channel, it should continue lower. And the same thing to the upside, okay? And once you see that burst outside the line, you want to remain in there until it breaches that midpoint line, okay? Jose is saying, Vince, would you say the Keltner channels are used the same as the Bollinger Band? In that instance, yes, they are used that way, but not with everything that I just described, okay? Louis is saying it's also used as a trend indicator. Absolutely, it is. Stuart is saying I find it works well for trading pivots. Great point. A spike above or below has a tendency to snap back towards the mean. Absolutely. You're all absolutely correct. So this is the thing about indicators. It really comes down to personal preference and what you're comfortable with. We can all find ways to use indicators. And in some instances, they will all work. some work better than others, but it also comes down to fitting them into whatever trading system or whatever trading style you have. So you're gonna get a lot of information today, a lot of different ways on using indicators. Please understand, I'm not saying now take all of this and go out and use all of it. No, you're going to drive yourself crazy. You can't. All right. But what you want to do is find the one or two things that really suits what you're doing and go from there. Okay. So let me just double check here and make sure that I haven't missed anything. Let me just switch. Bear with me while I look through the question chat box as well here. All right. So I think we pretty much covered this indicator. The other thing I wanted to mention to you is that basic technical analysis fits into whatever indicator you're using. And when I say basic, for example, trend lines. So look at this area back here on WDC. Okay, we were basically going sideways. You see the band squeezing, right? One of the basic things with technical analysis is just breaching a high or a low. So if we mark the low point during this area and you wait for a break below, okay? And you'll notice that as soon as you do, you actually close right at the bottom there, even outside that standard deviation line. Now, remember, I have here a 3 standard deviation. This is extreme. The default is 2. So on the 2 standard deviation, we would have been outside this band. Okay? Let me go back in and change that and show you before I move on. So if we go back to 2 standard deviations here, you'll notice now that when we broke that low, we went right outside the band. That is exactly what you want to see on a breakout. Why? You want momentum behind that move. That's what you're looking for. You're looking for that thrust out of that sideways pattern. And all you have to do is draw a line at the low and wait for a break. And when it did, the fact that it closed outside the Bollinger Band there let you know, hey, we've got an extreme move happening. And look, how easy is it to stay in that trade? Not even until it closes above the 20, but when you're riding the outside of the line like that, that's powerful. You never want to sell or close out your position as long as you're on the outside. That's a very, very strong momentum move. Okay? So that's the last thing I wanted to cover on that. So let's see. Richard was saying, are there any option strategies that are commonly associated with Bollinger Bands? Yes, Richard, great question. And what they are credit spreads. And the reason we have that is because we know the stats behind the standard deviation lines. So for example, on a 2 standard deviation, we know that price is going to remain within the bands 94% of the time. So when you see a breakout like this and you get some kind of indication or signal, and look, let's zoom in here. Look at this trade. Everything's dropping, red, 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 red. Suddenly we get a hammer candle. When you see hammer candles, a reversal signal. Now we've been outside that band for a long time, which isn't typical because we only spend 6% of the time outside the bands. So when you see that reversal, it's telling you it's coming back within. So what you want to do at this point is sell a put credit spread in here, okay, to take advantage of that move. Now, I personally prefer to do that with the 3 standard deviation. There's going to be fewer trades, but it's a lot safer because with the 3 standard deviation, you're only going to be wrong 1 to 1.5% of the time. 98 to 98.5% of the time, it's going to be within the bands. So as soon as it pops out, gives you some indication it's coming back in, you sell that credit spread. Okay? And the same works the other way. If you get a move outside the top bands and you get an indication that it's coming back, like a bearish engulfing setup, then you sell a call credit spread somewhere in here to take advantage of that drop. Okay, that's very common. Karen is saying, for day trading on a lower time frame, would you use the same setting? Yeah, it really doesn't matter. Same settings, but I would encourage you to play with the 2 standard deviation, the 3 standard deviation, because it also changes by security. For example, if we look at a Tesla on a 5-minute chart, okay, you might get a lot more volatility. There might be a lot more times where it's outside the band. If you see that, if you see a stock that seems to spend more than 6% of the time outside the bands on a 2 standard deviation, then it means you should switch to a 3 standard deviation. Okay? And do that. Cynthia saying she puts both 2 and 3 standard on the chart and uses that channel for breakouts. Another great idea. Fantastic. Thanks for sharing that with us. William saying, have you found any of these indicators, OBV, Bollinger Bands, that improve the results of your momentum, favorite veracity systems? Well, some of these were part of the original versions of those strategies, but to increase level activity without impacting accuracy, some of these were removed during that process. But yes, some of them were in there at the beginning. The combination of the indicators that I use for those strategies now seem to work a little better. But again, it may be different for you. You may be able to incorporate one of these with one of those strategies in a way that helps you with your trading. You know, if you want one more added level of security or confirmation, you can add, say, the on-balance volume or even the Bollinger Bands. You know, having a look at when you see a breakout on veracity, if it happens to close outside the Bollinger Band lines, then great, fantastic. So, you know, I remove some of those indicators to allow it to give me more signals, but it doesn't mean you can't use them. Okay, all right. Let's move on here, and let me go back first of all. Let me clean up this chart, and then go back to my presentation. So next we have parabolic SAR. Now it's a very common indicator. It follows price, and it can be used for 2 things. It can be used as a trend following indicator, okay, to confirm a trend in a specific direction, or it can be used as a trailing stop. And the SAR part of the indicator is known or stands for stop in reverse. Okay, typically this is used as a trailing stop. Okay, and so the indicator will be below prices when that stock is rising, or above prices when that stock is falling. I'll show you on the chart. Now, all day I've been talking about stocks. All these indicators work just as well on futures contracts, forex pairs. It doesn't matter. I'm going to say stock. All I'm talking about is the instrument that we're using on our chart at that time. Okay, so let me show you a clear example of this. Let me go back here and put on the parabolic SAR. Now, this is one particular indicator that I wouldn't use alone, okay, to make decisions just based on this indicator. But it's a great indicator to use along with other ones. And as we go through this, I'll show you which ones I use it with. But the settings, can vary dramatically. Now, you'll see that I have here a setting of 0.02 and 0.2. This is about as tight as it gets. Normally, the default will be 0.08 and 0.9. I've tightened it up dramatically. I'm conservative, and this is the setting that I prefer to use. Let me show you what it looks like. These are the dots here, and maybe I should change the color just to make it easier for us to spot. There. So you'll notice that when price is rising, the dots are below the candles. When price is dropping, the dots are above. Okay? So it can be used to confirm trend and use that slope just like you would the 20-period moving average, for example. Okay? Or the fact that it's below the price means price is rising. So it's something that can quickly and very easily help you confirm which direction that underline is moving right now. Now, that setting, if I had left the 0.08 and 0.9, these dots would start somewhere down here. And as the price moves, it'll slowly and slowly tighten up and get closer and closer to the price. So this is a trailing stop, basically. And the farther you move into the trade, the tighter it becomes. What I find is that using that 0.02 and 0.2 settings, basically it starts off at the most recent pivot, okay? The most recent low when it's trending higher and the most recent high when it's trending lower, okay? And then throughout the life of the trade, it starts tightening it up and tightening it up. And the only time you'll see the dots move from either below to above or vice versa is when price goes through that level. So each dot is where your trailing stop should be. And it'll remain here until price breaks below that trailing stop or triggers that trailing stop. You'll notice that this red candle here is when it dropped below this level. Can you all see that? Let me zoom in for you. Right, you see this was the most recent dot below the candles. Suddenly this candle came through that level. Okay? So if our stop was here, it would have been triggered. The second it's triggered, the dot appears now at the top because price is moving lower. And it will remain at the top until price breaks through that level, which happens here, and then it'll switch to below. So if you want to just use this indicator for entries and exits and say to yourself, well, whenever it's below, it moves from above to below, I'm going to go long. And whenever it moves from below to above, I'm going to go short. You're going to have a very difficult time making money in the long run, okay? Because believe it or not, stocks spend more time trending sideways than they do actually trending either up or down. So in periods of sideways movement like we've had recently in here, the S&P and the Dow, etc., you're going to get chopped up pretty bad. All right? So it works much, much better in stocks that are trending. But that's why I say rather than using it alone, you want to use it along with other indicators. Okay? And there's one that I will share with you later that I add this to that works quite well. Okay? Any questions on the parabolic SAR before I move on? We still have a lot of ground to cover here. All right. Let's clean this up and move back. Next is the MACD. Okay. Now, stands for Moving Average Convergence Divergence, and this is an indicator that I use mostly for divergence, but it can be used several different ways. Okay, it's an indicator that's going to fluctuate above and below the zero line, and you can use it with the histogram version, which is what I prefer. But you can use it for, it also involves a couple of moving averages in here. And when those moving averages cross, they give you a signal. When it moves up from below to above the zero line, it gives you a signal. There's many ways to use it. It's a very old indicator, very popular, and most traders like to do exactly that. Take signal line crosses, take center line crosses, and use it for divergence. And so let me show you a few ways to use the MACD. Okay, let's go back to a chart of AWK. It's a nice trending chart, makes it very easy to spot. Let me show you the MACD. Here, we'll put on the regular MACD for now, not the histogram, even though they're pretty much the same. And you'll see here that it's based on three moving averages, the 12, 26, and 9 exponential. Those are the default settings. Okay. For this example, we'll leave it at that. Then I'm going to show you the setting that I would use for an intraday chart. So you'll notice that here's the histogram portion, these green bars, red bars, black bars down here that cross above and below the zero line. And then there's these two moving averages. So again, one of the main ways to use it is for divergence. Okay, so if you take the peaks of the histogram and you draw a line across the peaks, okay, so here let's do this. Let's take a line here and draw a line across the peaks. Okay, we'll do it roughly here. You'll see that most peaks are getting hit right along here. But if we use those same 2 points, look, starting from here, okay, up to here, whether we use, let's use it here. Look at the difference, dramatic difference. While price kept rising, we had the indicator completely flat. This is telling us that this upswing isn't going to last very long, or shouldn't last very long. It is going to turn around. Now, we don't know when, right? So again, we need to look for a reason to switch from uptrend to downtrend. Easiest way, the most basic way, is look for lower lows, lower highs, right? Right now here, throughout the life of this, we're putting in higher lows and higher highs, higher lows, higher highs, right? Higher lows, higher highs. Then suddenly we switch to a lower high, right? Lower low, not yet. Lower high. And then we put in a lower low. And now we've turned the corner. The other thing we can do is look for a trend line break. And you can either draw a trend line on the bottom of these, or you can duplicate this and use it like a channel, right? Look for that break here. Now, here's the different ways that people use this indicator. Their divergence is one, for sure. And one thing about divergence is where it's most powerful is longer term charts. So if you want to spot the longer term trend, you use divergence. So if I don't know if we're going to see anything here, but if we were to look at the monthly here, let's actually draw this line here, okay, and take the same points on this line. Okay, not dramatic at all, but you can see here, if we zoom in, that one was pretty flat and the other one was sloping higher, right? I could have drew it a little closer to here, but it'd still be sloping higher. So that's telling you a breakout was coming, okay, on the longer term chart. Now, the basic technical analysis is a break of the previous highs. If we extend this line out across, right, it broke the high. From that point on, it's been in an uptrend. So it doesn't mean you have to buy the stock and hold it for several years. But once you see that, you know that now we're in an uptrend on AWK. You switch to the daily chart or whatever time frame you prefer to trade, and from that point on you start looking for long trades, whether it's using one of our strategies or anything else. The other way you can use the MACD is on crosses from below the zero line to above. So you're going from negative to positive, and you can initiate a long position that way or confirm it. It's often used as a confirmation indicator. So, for example, if we get a pullback like we do in here, okay? Now, in this case, it didn't work very well, but we pull back, we get a bullish engulfing signal around here. If we wanted to confirm that, hey, is this a good setup or not? And we look for a positive MACD. It didn't show us one there this time, but often it does. Back in here, it did. Okay? That's one way to use it. Most people use the cross of the these moving averages. But what you're going to notice is that there's a lot of false crosses. In other words, look at how the green line crosses from above to below the purple line, which would normally signal a short, right? Now, you're above the zero line, so you really shouldn't look at it there. Okay? You should only look for those crosses below for short trades or above for long trades. Keep that in mind. But an even simpler way of doing it, let me show you something that I haven't seen many others use. You want to actually go on your chart and put on the same moving averages. So I'm going to put on, I'm going to use exponential, and I'm going to put on the 12. Let me thicken this. The 12 and the 26 moving average, which are part of the actual indicator. Okay? Now, notice how the 12 and 26 on the chart, we get a cross here, and then it remains above. The 12 remains above the 26 that whole time. So it was in a nice trend here. But in between there were several crosses along the way, right? So you can use that as well and only take crosses to the upside, like here, okay, for that. If it's crossing above here and these averages are aligned properly, that's what you want to look for. When the 12 breaks below the 26, then you're only looking for crosses that happen to the downside here. Okay, you can use it one way or the other. What you'll notice here is that whenever these lines cross, that's when there's a change from below that zero line to above the zero line at every cross. Okay, so you can even remove these lines and just use the histogram, which is what I prefer to do. Okay, any questions on that? And before I give you the intraday settings, that is. I see questions on the cloud, which I'll get to in a second. Louis saying, does it only work in trending stocks? No, it doesn't. I mean, obviously, it will work better on trending stocks. Everything does. But the MACD is fairly reliable, actually. And on the MACD histogram, yes, Louis, you always draw the lines from peak to peak. So you take the top of the histogram to the top, or if you're looking the opposite way, you take the bottom of the peak to the bottom. So look at what we have here using these peaks. Okay? Right from in here to, well, where we are now. So, and maybe we should remove the moving averages just to make it clear. Look at the trend on price and look at the trend on the MACD, right? So you could look at it that way. I prefer to use these peaks, but even that, look, the slope on price is much more dramatic than here. So for AWK, when you're looking at this, what I think immediately is I'm looking to my left to see if there's any sort of major support that could hold here and make this reverse. Okay? That's what I'm looking for here, because divergence is telling me, hey, it may be slowing down here and get ready to go back up. Okay? That's another way of using it. Now, if you want to trade with the MACD intraday, say on a 5-minute chart, here's the settings I would use. And I am actually going to just put on the histogram version so it doesn't have those lines. Easier to read. You want to switch the 12 to 4, the 26 to 5, believe it or not, and the 9 to 13. 4, 5, 13. Don't ask me how I came up with this. Many years ago, lots of testing, 4, 5, 13. Now, and actually let me thicken it up and see if we can make it a little easier on the eyes. Okay, can you all see that? Maybe the green. See if I can change the green. Okay. Now, the reason why we changed that is because we want a much more responsive MACD for an intraday time frame. Farzad is saying, what about for the 1 minute? For me, it really doesn't matter whether it's 1 minute, 3 minute, 5 minute. It works very well in the 5 minute, but it should work on the other time frames as well. The 4, 5, 13 setting for intraday works really well. You're going to get a lot of crosses back and forth, no question about it, but it works quite well. And again, I don't use it as a signal by itself. I use it along with other indicators to confirm moves in that direction. So you'll notice here, okay, when it went negative, right here, the price collapsed. Okay, that sort of thing. If you look back in here, when it went negative here, price dropped. Went negative here, price dropped, and so on. Now, of course, you want to be following a trend. You want to look at other things, but it's there for confirmation. Okay, so 4, 5, 13 are the settings for the intraday MACD. Okay. All right. Any other questions on the MACD? I know there's a lot of info here. It is being recorded. Go back, watch this recording a few times. But remember, the intent here isn't for you to walk away and use all these indicators. It's just to educate you on the options out there and to select the ones that might help you with your trading. Okay? Let's have a look next at the Vortex. How many of you are familiar with the Vortex indicator? Now, the Vortex, yeah, I see many of you saying never. Absolutely. It isn't very common at all. It is now in more and more charting platforms, though, and it's a nice indicator, actually. It's generally used to identify the start of a trend, okay? And it can also be used to confirm a trend. I'm not going to go into the calculation of it too long. We don't have that time here, but basically there are two lines. And when the green line crosses above the red, you're talking about the beginning of a bullish trend. When the red crosses below the green, you're talking about, or above the green, you are talking about the start of a downtrend. Let me show you what I mean on the chart. Let me bring up, here, let's go back to a nice trending chart and show you the Vortex. Where is it? Vortex indicator right here. Select, again, I do not change the settings. This has a setting of 14. I leave it like that and just throw it on. Now you'll see here at the bottom, and let's have a look. When the lines come together and green crosses above red, time to go long. Okay? When red crosses above green, time to go short. Okay? If you've ever used the Arun indicator, it's similar to that. This is fairly reliable though. I do like this indicator. But again, it's there really to use as a confirming indicator. And what I really like this for is to confirm patterns, like a double top. Yes, Vas was saying similar to ADX. Like a double top, a double bottom. If you were to have a double bottom, like let's say a double bottom starts to form here, okay? And then at the time where you get a cross where price breaches the midpoint high, green were to cross above red, that is the kind of signal that I would use this for. Okay? Very, very useful. We can look at any stock here. Let's look at Netflix. You'll notice here, green, red, cross above green, we start moving lower. Look back here, red, cross above green, we move lower, and so on. It is fairly reliable. Again, I wouldn't use it on its own. Why? Because during times when it moves sideways, you're going to get chopped around. Like most lagging indicators, that's what will happen. During sideways markets, you'll get chopped. That's one of the biggest challenges during sideways markets. So instead, look for patterns. Okay, look for double bottoms, double tops, even pullbacks into a line. Like for example, well, actually, let's go to the Dow, for example. Here's the double bottom on the Dow, right? So when was the midpoint high broken? Right? When it was, look, green had already been above red. That's great. So that's what you want. You want to use it as a confirming indicator. But let's look at something like CMG, for example. Okay. And actually, let me put a bit more data on this chart. Go back to those drops. So when you get a pullback, you know how we use the 20 to judge momentum? We wait for a pullback and we wait for some kind of reversal signal, like a bearish engulfing setup. Well, look, red clearly way above green. It had crossed long ago, confirming that we're clearly in a strong downtrend. And you get that signal, and off the stock goes. So that's what I mean by using it as a confirming indicator. Okay, if you get a pullback, like you did in here, and it's overlapping, it's not very clear, then I wouldn't trust that as much. Here, very, very clear signal, very easy. Okay, you can also use, as Brian is just suggesting. Actually, let me just read his question. Yeah, so he was asking me to mention the indicator that I usually use with the parabolic SAR. And I will certainly do that. This is one of them, actually. When you get a cross like this, red over green, and it looks like it's going to go short. See, at this point, we weren't really in a downtrend, were we? We were more in a potential double top kind of situation. Now, we had this big green bar that breached this low, so that's more of a breakout situation, which is great. It confirmed that breakout. But when you see these two lines cross, you can throw on a parabolic SAR at that point and just follow that as your trailing stop. And if it doesn't work, if it chops you quickly, it'll get you out. The parabolic SAR will get you out fairly quickly. So your losses will be smaller, but you'll catch some nice runners. Okay? But I thought I'd share that with you because not many people have heard of this indicator, but it actually can be can be quite handy. Okay. All right. Karen says, yeah, she has used the Arun. Yeah, I think I'll cover that in the next class. Well, let's clean this up and move on. We've got a couple more here to cover today. So the Williams percent R. How many of you have heard or have used the Williams percent R? Yeah, okay. Most of you have, some of you haven't. Let's go over this. The Williams percent R is another one of the oscillators that helps you identify overbought and oversold conditions. It's a very popular one, and it's actually a very reliable one. It ranges from 0 to minus 100, and it'll fluctuate in this range. Now, the key here is that we usually use the 20 and the 80 levels to determine the overbought and oversold conditions. But let me show you a unique way of how I use this indicator. Again, not many people have used it this way. And let me show you this. So, first of all, here's the indicator at the bottom. Now, you'll see that the default gives you these lines, the minus 20 and the minus 80. So what it means is when the line gets to the minus 20 or above, it's overbought, and you should expect a pullback. When it gets to or below the minus 80, it's oversold, and you should expect a bounce. So most people use it to generate buy or sell signals based on when the stock comes out of that area. So in other words, if the stock drops and goes below the minus 80 level, when it crosses back above, that's when they would initiate a long. Or when it goes above the minus 20 and then crosses back below that minus 20 line, that's when they would initiate a short. Now, if you go back and look at all those signals, you'll see that it's not very reliable when it's used just like that, okay? And that's what I found. It's really not. So another thing you can do that is more reliable is remove the minus 20 and the minus 80 lines and draw one at the minus 50 line, right down the middle, and take those crosses. Those are a little more reliable, okay? The other thing that's very common is to use extreme levels. So to change the minus 20 and the minus 80 to the 0 and the minus 100. Let's go in and do that for a second and show you what I mean. So if we move this to 0, actually, sorry, not that. Sorry, let me clean this up. Let me put this back on here. Clean, make sure there's no mistakes. There we go. So if we put this to 0, okay, and use extreme levels and the minus 100, now you'll notice that rarely does it actually get to those levels. Does it actually touch those levels? But when it does and reverses, that's when you can take short positions. Again, not super reliable, but a little more reliable, okay? But now, here's the way I really prefer to use this this indicator, okay? This is my method, and I actually call this, and you all know that myself and Raul are big fans of Seinfeld. I call this the George Costanza method because it's the opposite of what most people would be thinking. I go long whenever we get to the overbought condition, and I sell short whenever we get to the oversold condition. So, and this is where I would use, I think it was David or Brian that had asked, this is where I would use the parabolic SAR along with this indicator. So if I'm initiating along when we cross to the overbought situation like here, that's where I would plot the parabolic SAR. Okay? Now, throughout the life of that trade, you're probably going to get several crosses back up and below that minus 20. It doesn't matter. Ignore that. I look at the initial cross, I go long, and then I use the parabolic SAR to tell me when to get out. Okay? If you look at every time it goes overbought, generally, there's movement in that direction. It tends to stay overbought for a little while. Okay? Not always, but in most cases. Let's look at a cleaner. And remember, you always want trending stocks. But you see how many times it crosses back and forth? Once you get in one, plot the parabolic SAR and stay in it until it gets you out. When it gets you out, look for the next cross above, plot the parabolic SAR and use it that way. That's the way I use this indicator. Now, Louis asking, for the oscillators like Williams %R, stochastics, RSI, which one do I prefer and why? I don't really prefer one over the other. I mean, I do find, I must say, that stochastics, which I will cover in a minute here, is very reliable. The one I use the most is the RSI. That's the one I've incorporated into my strategies and I use the most. But again, I don't use it to identify overbought and oversold conditions the way it was meant to be used. I use it to identify that setup candle for my system. So it's a little differently, but that's they're all fairly good. So that's the Williams %R. Any questions on Williams %R before we move on? And Karen is saying, would you use the %R for day trades and in which settings? I actually never have used it for day trades. Again, let's have a look at the 5-minute. When you go oversold, here's a 5-minute, you can short and use that parabolic SAR. It works the exact same way. I think the settings, it's got a setting of 10. I don't think you need to change that. You can certainly test it on the lower time frames. And as I mentioned, test it with a line down the middle at the minus 50 and remove these. That'll give you the bigger crosses. It'll help you predict those price moves a little earlier. Try that. But to answer your question, no, I've never used the Williams %R for day trades. Okay. Boy, we still have 3 more here. Let's try to get these in quickly. We're starting to run out of time. Let's see. Okay. So, Vasu, I see your question, and I promise about the setup scans. Maybe we can cover that in future classes or in the market chats for sure. I won't have time for that right now, but let's get back to the presentation here and look at the cloud. Now, many of you have heard me talk about the cloud before. We do use it in some of our systems, and we have taught classes on it before. I will quickly go over this. Again, what it does do is gives you clearly, it defines areas of support and resistance. It helps you identify trend, which is the way we use it most, and it also helps you gauge momentum as well and provides trading signals. So this is an indicator that actually is a strategy in itself. That's not the way I would use it, but I will show you both. The translation of Ichimoku Kinko Hyo is one look equilibrium chart because it really does everything. It shows you everything on one chart. Okay, where I find it most useful again is by packaging it with other indicators and helping you with identify trend. So let's put this on the chart here. Let's clear this off and go to the Ichimoku. All right. So Here you see a bunch of lines. And actually, let me go to the daily so that it's a little clear. Hope all of you can see that. Now, we normally use the cloud portion, this yellow shaded area and the red shaded area, for trend. When price is above it, you're in an uptrend. When price is below it, you're in a downtrend. When it's overlapping it, there is no trend. Okay? That's a quick and easy way to read it. The strength of momentum comes in with the size of the cloud. Okay? So you'll notice that in some areas the cloud is very thin, and in others it's much thicker. The thicker it is, the stronger the trend in that direction. So the thicker the yellow cloud, the stronger the uptrend. The thicker the red cloud, the stronger the downtrend. Okay? These also act as support and resistance. Okay? So the top end of the cloud will be your first level of support. Bottom of it will be the next level. The red cloud, the bottom end will be your first level of resistance. The top will be your second level of resistance. Okay? Now these moving averages, there is this red line up in here, which is the Chiku line, but otherwise known as the lagging line. Okay? You'll notice that it's 26 periods behind price. And then you have the green line, which is known as the leading line, or the Tenkan, and this pinkish line, which is the Kijun, which is the base line. Couple of different ways to generate buy and sell signals. One way that's very common is when price comes through the cloud, a number of traders wait for at least 2 bars below the cloud or above the cloud. And then once they get those 2 closes below, they'll short it, or if they get 2 closes above, they'll go long. That's a very simple way. Another way they use it is when the Chiku line, this lagging line, crosses. That's when they will switch from, say, long to short, or vice versa. Okay? But the most popular way is to use that leading line and the baseline and the crosses of it. Okay? So when the green line crosses the red, and you have to go to way back here to see it. I don't know if you can. Let me zoom in here for a second. Right here. You see that? Where it crossed from below to above that pink line? Okay? That would have been, and the fact that it happens above the cloud, that's the key. That's your long, your signal to go long. Okay? When it's below the cloud and the green crosses below the pink, that's your signal to go short. Right? That's the way this indicator was meant to be used. We simply use it for trend. We don't really care how thin or how thick the cloud is, or what it's projecting in the future. We basically look for, is price above it, below it, or overlapping it. It's very, very reliable. But the single the one thing that I use it the most for, that's what I'm trying to say here. The one thing I use it the most for is to help me build watch lists. And for that, what I do is I plot that 20-period moving average on my chart. Okay, let me throw one on here. Where is it? Oh, that's right. It's under simple. I plot the 20 on my chart, and I wait for it to cross the cloud. Now, I'm going to make this very thick so we can all see this compared to the other lines there. When it crosses the cloud from one side to the other with a slope, and the more dramatic the slope, the better, then you tend to have a large follow-through move in that direction. So I'm basically looking for stocks where that moving average has just come through. And then I'll use my other systems to generate signals along the way. But if you build a watch list of stocks that are just breaking down or breaking up through the cloud, you'll have a watch list that'll keep you very active with trades. Okay. That's what I find most useful with this indicator. Any questions on that at all? Okay, I didn't think so. Most of you are very familiar with that. Let's move on. We've got two more to cover here. So next is the CCI. Now, what this does is measure the current price relative to the average price over a given period of time. Okay, and again, this is truly meant to identify overbought and oversold conditions. All right, so let me bring up the chart again and throw this on and show you how most people would use this. Again, default settings in most cases. Intraday, different setting, and I'll give you that in a second. But 14 is the default. Some charting platforms use 20. I prefer the 14. Again, we have the plus 100 and the minus 100 signs. When the line crosses above, that's considered overbought, and you should look for a pullback. When it comes below the minus 100, that's considered oversold, and look for a bounce. That's the traditional way that it's used. I much prefer to use the zero line and use the crosses of the zero line in conjunction with other indicators to spot a move. Let's use AWK here for a second and show you, if you look at the crosses above or below the zero line, okay, they tend to give you those spots where we get a nice burst. Okay, now it's very similar to the Williams percent R. So you can go back to the recorded portion of the Williams percent R and use the CCI the exact same way. Okay, all the ways I talked about the Williams percent R, you can use with the CCI. Okay, so you could take, you can go long when it gets overbought and use the parabolic SAR, just like the Williams percent R. It's basically very, very similar. Okay. Now, if you're trading intraday, I would change the setting to 5, from 14 to 5. And again, I would remove the plus 100 and minus 100 lines. Let's go in here quickly. Leave the zero line, overbought, uncheck, oversold, uncheck. Change this to 5. Okay, thicken it up. There we go. Move to a 5-minute. Okay. Now, AWK might not be a stock you necessarily want to day trade, but most often than not, you see how responsive this is? A lot of triggers. You would not use this as an indicator on its own for that. You want to use it in conjunction. One of my favorite ways of using the CCI 5 for intraday charts is to use it with that special setting on the MACD, the 4-5-13. And when they're both positive or both negative, they work very well together. Okay, so you can have a look at those. Richard's asking if I use the TOS scan tool to create watch lists. I use several different tools. I'm still pretty old school, Richard. From time to time, I prefer to flip through charts manually. That gives me the opportunity to visually spot many different things on it. You can certainly use the TOS scan tool. You can also use stockcharts.com. They have a scan of when price is moving either above or below the cloud. And if you just plot your 20, usually the 20 is either close behind or has already crossed you, so you can use that. It's a pre-formatted scan. But I, from time to time, like to just flip through manual charts and make a note of the ones that are just about to break. Okay. One last one here. Let's clean this up. And here, I'm going to use a different stock here. Let's go back to my presentation. Now, stochastics oscillator, and this is a very, very popular one, and it's actually a very good indicator. And there's different versions of it, and you'll notice that there's a fast, a slow, and a full in most charting platforms, okay? Again, it's a momentum indicator, and it shows the location of the close relative to the high-low range over a set number of periods, okay? It follows the speed or the momentum of the price, okay? So generally momentum changes before price, and that's what it's there to help you identify, okay? And this is another indicator that's used a lot for divergence, okay? So let's go back to the chart here and throw on stochastics. Now, as I mentioned, there's different versions here. Right in here. There's fast, there's slow, there's full. I prefer the fast. You can also use stochastics RSI. It's a mix of the two, and it works very well. But stochastic fast is the most popular. Again, default settings. Don't really touch it. Default settings. And this one is really used once again as, for me, a confirming indicator when you get price below that 20 level, so it's considered oversold and you're looking for a bounce, and then you get the two lines crossing, okay? So you get that, the red line crossing above the purple line and both moving above the 20 level, and that usually signals a decent turn. Now, where I really like this is on channels, okay? If you look at a channel and you find those areas where you're crossing from below to above the 20 line, when price is at the bottom end of the channel, or you're moving from above to below the 80 line when price is near the top end of the channel, okay? It really works quite well, okay? That's my favorite. I'd have to look for a stock with a channel here, but there's one other thing I want to show you quickly, and that's to confirm reversal signals along trend lines. This is one of my favorite as well with this indicator. Let's go back to AWK and show you that during this drop here, okay, let's say we use a simple trend line here, okay? Now, this is always great, basic technical analysis, and whether you're using an actual trend line or you're using something like the 20, you know, you're always going to get those pullbacks and those reversal signals, like here, bearish engulfing setup. Okay? Well, an extra layer of confirmation on those is when the stochastics goes into overbought territory and crosses back below. And there's a couple things here. Look, it's not necessarily when the lines cross below that 80 level. You can use that as well. But the cross from the red below the purple there is giving you that heads up, and it's happening at the same time as a bearish engulfing setup. And you know that you have a strong trend in that direction as well. So then, you know, you would use your same rules, mark the low of that setup. When you get a break, you enter and off you go. Okay, you can even plot the parabolic SAR to then trail your stop, however you want to use it. But using the stochastics either in channels to help you judge, and thanks Connie. Connie's saying Win is in a channel right now. Let's see how it would work on Win. Okay, great. Thanks for that. Let's plot this channel here. All right. And look at this. Now we're at the bottom of the channel here. Okay. And what do we get here? Look at this formation. Okay. You know the morning star type pattern. Okay. Look at stochastics. Had gone oversold, crossed above right here, and that's when it moved from the bottom end to the top end. Here we get a bearish engulfing setup. And this is the thing about channels. Don't ever forget, usually you get very clear reversal signals at top and bottom. Okay? Here's another one. Was the price overbought at the time, and did we get a cross? Yeah, we did. It comes to the bottom here. We even get like a double bottom formation. Now, do we come out of oversold territory? Yes, we do. Where do we go? To the top end of the channel, right? Here is another turnaround, and there we go. And here at the bottom, again, it matches up very, very nicely. Okay, it matches up very, very nicely on here. So it's definitely something to consider with channels and with trends. Okay, if it's a very strong trend and you don't get much of a pullback, like here, if we had tried to use this, for example, okay, you don't get much of a pullback. It's not going to come back. It's not going to come back far enough. For some reason, my mouse is acting up here, trying to get down to the indicator. That's odd. Okay, well, not sure why I can't move my mouse below that level on the chart. What I was trying to show is on the stochastics, during a pullback here, let me try it this way. There we go. See this pullback here? It didn't come far enough, and the stochastics didn't make it to the oversold territory. Okay? But when you get a nice decent pullback like this one, then it comes back to that line and then crosses back above. So those are the couple ways that I prefer to use that. Okay. Richard is asking, do I find similarities between the stochastics and the Williams? Absolutely. Absolutely. That, the CCI, the RSI, if you use it with the overbought and oversold, they're all very similar. So one isn't necessarily better than the other. I can tell you from a popularity standpoint, I think the stochastics is the most popular. Second would be the relative strength index, the RSI. Okay. So yeah, use whichever one you feel comfortable with. And again, how you use it, the best answer is what you're most comfortable with. There's no right or wrong way. What I will say is, whichever method you're planning to use, do some testing with it before you trade it with real money. Okay. And actually, Richard's asking if I can put the Williams on the same chart. Sure. Let me clean this up a little. Okay. For some reason, my mouse here is not working. All right. Let me use something different here. Let's go and put the Williams on. So you'll notice here that they're very similar, right? They're almost identical. If you look at when they go overbought, right? When they go oversold, they look almost identical, right? So they're pretty much interchangeable. They really are. If you wanted to use the extremes on stochastics instead of Williams, it's the exact same way. You'll notice that when you approach the 0 level here, you almost always get a bounce when you approach 100. Okay, so fewer signals, fewer setups, but more conservative. Okay, so that's the other thing about indicators. You can play with the settings. Find one that works for you. The more aggressive you are, the more you want to loosen that indicator. The more conservative you are, the more you want to tighten it up. Okay? So, but you'll find the CCI, stochastics, Williams, RSI are fairly similar. Okay? So those are all the indicators. We've gone for over an hour and a half now. Any questions on any of those before we wrap this up? And once again, by all means, when we have our future live market chat sessions, if you're playing with these indicators and have any questions, bring them to the live market chat and I'll answer them for you there. Okay, or send me an email. We're here to help. Brian is saying, favorite indicator used with PSAR. I really don't have a favorite. What I do like about the parabolic SAR is tightening it up to the 0.02 and 0.2 setting and basically letting it tell me when to get out. So I do like using it with the Vortex, but just in general, even with the stochastics or the Williams. With the Williams, when I initiate that buy by going over bought, and then throw on the parabolic SAR. So I do like that a lot. It works quite well. Okay. All right. So again, this will be recorded. It'll be in your video library shortly. Let me know if you have any other questions. Bring them to the live market chat. We have another one Monday. As you know, this week is going to be super exciting. Election day coming up Tuesday. So there'll be a lot to talk about for sure. Thanks again, everyone, for joining us on Saturday, and we will see you on our next chat. Thanks. Have a great weekend.